here with Bill Nelson, working harder.
Peter Heise, lending smarter. How are you? Hey, I've got a question for you. The best, this is the question I always get. How do I get the lowest payment with the least amount of money down? And the reason I'm asking you this question was the loan that you did for my people the other day. They put 5% down, but you were able to pay some upfront mortgage insurance, and it lowered their payment $200. Just briefly explain how that works, please.
So yes, it's actually possible to have a lower monthly payment in some situations with maybe a higher interest rate. How does that happen? Well, so if we can eliminate paying monthly mortgage insurance by paying an upfront mortgage insurance, what we call a single premium mortgage insurance, and in this case it was paid for by the lender with an increased rate because we were working on cash to close, or we were working within restricted cash to close. We were actually able to lower their monthly payment from where it would have been if they paid monthly.
So by taking a slightly higher interest rate, the loan is more profitable. You were able to make a lender contribution to cover some of that mortgage insurance.
Correct.
And the payment's lower with a higher interest rate.
Right. Otherwise, they would have paid mortgage insurance every month until they paid that loan down to 78%, and they would have ended up spending a lot more money.
Is there, for the folks that are putting 20% down, is there any way to get the best deal for them as well? Origination, no origination. What usually makes sense?
Generally, if I were doing a loan for myself, I prefer without any kind of buy down points, because usually those points take about 5 years to return any money. And I mean, you tell me, how long do people live in their houses on average?
About 7 years.
So, and they may move sooner. So, yeah, they might make out for the better for 2 years after that 5 years. But what if they move? I mean, so.
I gotcha. Well, let me take it a little bit different direction. The folks that put 20% down, they're going to compare your loan to the next person's loan, and I hear them all the time. Well, this guy's closing costs were a couple $100 cheaper. How do you want me to, do you want both good faith estimates side by side? What's the best way to compare what the lender's doing? And service aside, because I know you're going to get better service, but when they're trying to compare apples to apples, what's the best way to go?
Really, the only way is to compare apples to apples. Get the worksheets from both lenders and put them side by side and compare what it actually costs them to get that rate. Assuming the rate is the same, then obviously what they spend to get that rate is the difference.
So I just got one last question for you. Sleepover?